So you want to own a solar farm. Rows of panels stretching to the horizon, silently converting sunlight into cash, no smokestacks, no fuel deliveries, no moving parts to speak of. It's pitched as the cleanest, most future-proof business in energy. Sign a contract, flip the switch, and collect a paycheck from the sun for the next 25 years. Here's the paradox nobody tells you at the ribbon cutting. The single biggest risk in owning a solar farm has almost nothing to do with the sun, the panels, or the weather. It's the electrical grid itself. A piece of infrastructure you don't own, can't control, and are entirely dependent on simply agreeing to accept the power you're generating. This is an industry where you can build a perfectly functioning power plant and still watch it sit there earning nothing, or worse, paying to give power away, because the grid downstream of your fence line said no. Stick around. We're going to trace the transmission line on this one. Tier 1. Bootstrap. Somewhere between $1 and $5 million gets you a small community or commercial scale solar array, typically 1 to 5 megawatts, feeding a handful of local businesses or a single utility contract through what's called a power purchase agreement. This tier lives or dies on that one contract. Lose the buyer, and there's often no easy backup customer standing by to take the power instead. Tier 2. Mid-market. Now you're talking $20 million to $100 million for a real utility-scale solar farm, somewhere in the 20 to 80 megawatt range, selling power under a long-term power purchase agreement to a utility or a large corporate buyer. This tier requires securing land rights, an interconnection agreement with the regional grid operator, and financing structured around 2 decades of predictable, contracted revenue. Assuming every one of those pieces actually lines up on schedule, which is far from guaranteed. Tier 3. Institutional. $200 million and up for a massive utility-scale project, often hundreds of megawatts, built by major developers and typically sold to or co-owned with pension funds, infrastructure investors, and utilities themselves once construction is complete. At this tier, the actual solar farm is almost a secondary consideration. What's really being built and sold is a long-duration, contracted cash flow stream that behaves more like a bond than a power plant, priced and traded accordingly by investors who may never once set foot on the property. Notice the pattern climbing through these tiers. At every level, the panels themselves are almost a commodity. The real value lies entirely in the contracts and the grid connection surrounding them. A solar farm with no signed power purchase agreement and no confirmed interconnection slot is, financially speaking, worth close to nothing, no matter how many megawatts of panels are sitting in the field, because none of that generation has anywhere guaranteed to go. Here's the everyday version. Picture a farmer who's contractually obligated to sell every apple they grow to one specific grocery store at a price fixed 20 years in advance, and who has no legal way to sell to anyone else, no matter what happens to apple prices in the meantime. That's roughly what a power purchase agreement does to a solar farm. It locks in a fixed or slowly escalating price for electricity, providing predictability, but eliminating any upside if power prices spike, and offering no flexibility if the buyer's needs change. 2 numbers actually run this business. The first is capacity factor. The percentage of a solar farm's theoretical maximum output it actually generates over a year, accounting for nighttime, clouds, and the sun's angle. A well-sited utility-scale solar farm might run a capacity factor of 25 to 30%, meaning even under ideal conditions, the plant only generates a fraction of what its nameplate rating suggests, and every financial projection has to be built around that fraction, not the impressive-sounding megawatt number on the sign out front. The second number is the interconnection queue position. Before a solar farm can send a single watt into the grid, it has to secure a formal interconnection agreement with the regional grid operator, and in many parts of the country that queue is now backed up for years, sometimes with wait times exceeding 5 years just to get studied, let alone approved. Projects can spend millions of dollars in development costs, land options, permits, equipment orders, while sitting in that queue with no guarantee they'll ever actually receive a connection slot, or that the connection they eventually get won't require millions more in unexpected grid upgrade costs assigned back to the project. Here's the counterintuitive fact that violates normal business logic. A fully built, fully operational solar farm can be ordered to shut down and stop generating electricity, a process called curtailment, during the exact hours when it's producing the most power, purely because there's simply too much solar electricity flooding the grid at once and nowhere for it to go. Midday, when the sun is highest and generation peaks hardest, is now frequently the worst possible time to be selling power in solar-heavy grid regions, because every other solar farm nearby is generating at the same time, and wholesale electricity prices can actually turn negative during those hours as the grid pays generators to stop producing rather than accept more power than it can handle. Walk a modern utility-scale solar site and it looks almost eerily simple. Rows of panels slowly tracking the sun, a scattering of inverter stations, a security fence, and not much else. It looks like nothing could possibly go wrong. Underneath that simplicity sits one of the most complex regulatory and engineering negotiations in modern infrastructure. Every solar farm above a certain size has to complete what's called an interconnection study, a formal engineering review determining exactly how the new generation will affect grid stability, and whether the surrounding transmission infrastructure can even absorb it without upgrades. These studies routinely surface unexpected costs: a substation that needs upgrading, transmission lines that need reinforcing, and under the industry's cost allocation rules, the solar developer is often the one required to pay for infrastructure upgrades that will end up benefiting the entire regional grid, not just their own project. But there's a liability baked into every power purchase agreement that most buyers never model correctly: curtailment risk allocation. Some contracts guarantee the solar farm gets paid for its full contracted output even during curtailment events, shifting that financial risk onto the utility buyer. Others explicitly don't, meaning the solar farm owner absorbs the lost revenue every single time the grid operator orders a shutdown, with zero compensation for power it was fully capable of generating and selling. Get that contract clause wrong, and a project that looked bankable on paper can quietly lose 10 or 20% of its projected revenue to curtailment events nobody built into the original financial model. And there's a second hidden cost that rarely gets modeled honestly: panel degradation and the midlife inverter replacement cycle. Solar panels don't fail suddenly. They slowly lose efficiency, typically around 0.5% to 1% per year, meaning a farm's output 20 years from now will be measurably lower than on the day it opened. Meanwhile, the inverters that convert the panel's raw output into usable grid power typically need full replacement around year 12 to 15, a capital expense in the millions of dollars that has to be budgeted for a decade in advance, right in the middle of a contract that was priced assuming decades of stable output. The headline numbers on a solar project look almost boringly reliable: long-term contracted revenue, predictable output, government tax incentives sweetening the returns even further. But the realized returns tell a more complicated story once every risk gets properly priced in. Realistic unlevered returns on a well-executed utility-scale solar project tend to land in the mid to high single digits, climbing higher once leverage and tax incentives are layered in. Solid, bond-like performance, but nowhere near the explosive growth story that solar's headline installation statistics might suggest to an outside investor. The entire model depends on the interconnection process going smoothly, the power purchase agreement holding, and curtailment staying within modeled limits. Break any one of those assumptions for long enough, and a contracted, seemingly de-risked infrastructure asset can turn into a stranded pile of expensive equipment generating far less cash than the spreadsheet promised. SunEdison learned this the hard way. Once the largest renewable energy developer in the world, the company expanded aggressively through debt-fueled acquisitions, buying up project pipelines and development companies at a breakneck pace on the assumption that growth alone would keep investors and lenders satisfied indefinitely. When financing conditions tightened and the company's complex web of subsidiaries and yield vehicles couldn't generate cash fast enough to service its enormous debt load, SunEdison collapsed into bankruptcy in 2016. A company with real, functioning solar assets across the globe, brought down not by a lack of sunlight or demand, but by a corporate capital structure that assumed access to cheap financing would never end. California's solar industry tells a different kind of cautionary story. As solar capacity in the state grew explosively over the past decade, the grid began experiencing severe midday oversupply, a pattern known as the duck curve, where solar generation floods the system for a few hours each day and then vanishes entirely as the sun sets, just as electricity demand ramps up in the evening. Merchant solar farms without long-term power purchase agreements, selling directly into the wholesale market rather than under a fixed contract, began routinely facing curtailment and even negative pricing during peak sun hours, earning far less than their original financial models projected. This wasn't a story of too much debt against a stable business. It was a fundamental mismatch between when solar farms generate their power and when the grid actually needs it, a structural problem baked into solar's core physics that no amount of careful financing could fully solve. Two very different collapses. One from a corporate balance sheet that assumed easy financing forever. One from a physical mismatch between generation timing and grid demand that the entire industry is still working to solve. The panels kept working in both cases. They always do. Solar farms don't stop generating electricity when they fail financially. The contracts, or the grid's willingness to accept the power, do the damage instead. Strip away the panels, the inverters, and the renewable energy branding. What's left is one equation: contracted revenue per megawatt hour, multiplied by capacity factor, minus curtailment losses, minus the interconnection and grid upgrade costs required just to get connected in the first place. Realistic net returns, properly risk-adjusted, tend to land as solid but unspectacular. They're the ones securing the best interconnection positions and the most airtight power purchase agreements years before a single panel goes into the ground. NextEra Energy built one of the most successful renewable energy businesses in the world, understanding exactly this. Treating grid interconnection right. The system rewards whoever can lock in the best grid position and the most reliable buyer years in advance, long before ground is ever broken. Everyone else is just generating electricity into a grid that may or may not want it, hoping the interconnection queue moves fast enough, the curtailment stays manageable, and the contract they signed holds up for the next 2 decades.